Hey, calling all investors. Welcome, everyone. We're here with another weekly installment of Live with Caeli. Today is April 18th, 2023, and we are going to be talking all about lessons learned with regards to important property review mistakes. It is a collaborative event today, as always, so please make sure you leverage the Zoom platform to either virtually raise your hand. We'll take you off mute. You can talk it through with Caeli, or you can use the chat function, or you can use the Q&A. If you're listening to this on replay and you want to ask a question, you got 3 ways to do it effectively. First way is to email to info@ridgelendinggroup.com. Second way is to call, and that's 855-74-RIDGE. And third way is if you want to put a comment into the community and you want to get not only Ridge Lending Group's vibe on it, but you want to get other community members' vibe on it, that's another way. Now that Caeli is properly adjusted, we are going to talk about, again, learning important property review mistakes that are made and what you see, Caeli. And as timing would have it, Caeli, we just had one of these happen today. And so
I saw that.
we didn't do that on purpose, but it is important to really share that with the team and what we can do about it. So take us away, Caeli.
Thank you very much, Larry. Yeah, I slept weird. I'm trying to get a kink out. Hi, everybody. Thanks for being here. Just a quick heads up. I know last week, for those of you that were here, Michelle, first of all, thank you for sending me that pro forma. I had mentioned that we were going to maybe take pro formas and go through how to look at them, calculate ROI. But I started thinking about it because a few things similar to what Larry just mentioned happened today came across my desk last week. And I thought, okay, most of us, if not all of us here on these calls, know how to look at these pro formas and what you're looking at, right? You know how to calculate your ROI. And a lot of times it's going to be really subjective to the individual, right? And their expectations and their qualifications, because their qualifications individually can change what the rate and the terms end up being. And then the return ROI based on that changes too. So I really feel like those pro formas and how to recognize ROI and look at all those things, I think that those should be more individual one-on-one with me and or your dedicated loan specialist. So while this is kind of the same theme, it's similar to that. I really want to focus on investor due diligence because all too common, you guys, we continue to see a disconnect between what you guys or what investors expect the property and the return will be and what reality is. And what's more, I find that it's happening far enough into the loan process that it can be more costly than it needs to be, right? We need to be doing some of this due diligence on the front end to avoid, costs of appraisals or, right, all the other things that could come up, loss of earnest money potentially if you're outside your contingency, yada, yada. So I felt like it was similar enough to what I had kind of talked about last week and what we'll be doing this week, but even better, I believe. So let's get after this. First of all, I want to just preface by saying I'm going to focus today's investor property due diligence on turnkey properties. It should be the same, maybe a little bit more if you're going off the grid and doing your own. But a lot of us, I think, focus on the turnkey. Most of us have full-time jobs and we utilize or rely on the turnkey to provide us with the inventory, et cetera. But before I get into some of the criteria, let's make sure that we all have the same definition of turnkey, okay? A turnkey is a group or a company that has supplied investment property that has either been fully rehabbed, updated to whatever degree, but it is basically rent ready, okay? It's rent ready. It either has a tenant in it already, or they are going to be responsible to manage the property management themselves, or they're going to off book that and they've got relationships with property management. But turnkey means that the property is ready to rock, tenant there, or they're going to facilitate within property management to get it tenant occupied ASAP. That's the turnkey. So just making sure that we all have that same definition in mind. And while the turnkeys do a lot of the heavy lifting up front for us, I think that it's really important to notate it's not a set it and forget it, you guys. And that's why I think this due diligence conversation is timely and important, because there's human error. I don't want to go down a road that seems to imply, because it's not the case at all, that seems to imply that turnkey companies are somehow, they have it out for their investors. Of course not. They're not going to be in business long if that's the case. But there are mistakes that are made, or assumptions that, one side thinks that they're explaining it one way, when you get to it, it's interpreted a different way. So it's extremely important, while it is called turnkey, that the due diligence is on your shoulders to make sure that you have corroborated the information that they have supplied you about this particular investment that you're looking to acquire. Okay, it's entirely on your shoulders to make sure that all of that has been verified to the best of your ability. So taking the time to go through some of that, and some of the things that we see are often misses from our perspective, the buyer, the investor's perspective, just to kind of shine a light on it. Okay, so that's what we're going to go into today. Like Larry said, put your hand up if you have any questions, put it in the chat. We'll, as we always do, we'll do Q&A throughout. All right, so all of that said, there's three primary components that we're going to get to when we're doing the due diligence. I don't know if we're going to get to all of it today, and if we don't, we're just going to pick up where we left off next week, okay? I'm going to give you the three different primary objectives here when we're doing our due diligence, and then I want to take a second and talk about the turnkeys just a little bit more. So we've got, the first thing is going to be the property condition, right? That's going to be number one. The numbers, the overall figures of the deal, that's number two. And then property management will be number three. So as much of that we can get through as possible, we will. Otherwise, we'll pick up next week. But before I get to any of those, I want to make sure that everybody's is on the same page. It's not appropriate for you to be doing your due diligence about the market and or the turnkey company itself while you're in contract. You want to do that in advance. You want to make sure that you have taken the time to vet the turnkey itself and or the market that you're going to be looking to invest in. Do that up front. Don't do it once you've gone into contract, okay? All right, so let's start with property condition, okay? I've got some notes here that I'm going to refer to. All right, property condition, inspection. Make sure you're getting your inspections. Whether you think it's necessary or not, maybe you've seen the property, I am going to be the first one that steps up and says, no matter the circumstances, I am always going to get my own inspection. And it might be a good idea. A lot of times you're going to ask for a referral, maybe from the turnkey or whatever. If you're getting an inspector referral from the turnkey, again, not to say that there's any malice here, but I feel more comfortable or confident personally getting my own, right? Doing my Google search, finding 2 or 3 companies that do it, maybe calling and getting a feel for each of them, what they charge, what they do, all of that stuff. I want to have it to be the inspector to be completely disinterested and have no relationship or tie or getting business from the turnkey. Okay, so I would say that would be how I would do it. You guys do it the way that works for you. This is going to sound silly to some of you, but it's important that you're reading the inspections. Very oftentimes, especially newer investors, feel like just getting it is enough. You need to actually read the damn thing. And to that end, I don't want you to overanalyze the inspection, knowing that the inspector's job, gang, is to find things wrong with the property, even down to the minute details. That's their job. So if you get an inspection that's 20 pages long and you're thinking, oh my God, this property this isn't going to work. Remember that the small ticky-tack things, you really shouldn't be too concerned about. You're looking for the major issues: foundation, roof, plumbing, all of that stuff. That's really what you want to focus on. And when you're putting back, let's say some things come up and you're going to push back on the turnkey or the seller and say, I need these things to be fixed, right? That's really going to be what your expectation should be. Now, you certainly, I'm not saying that you wouldn't ask or you shouldn't ask or you couldn't ask for them to repair those smaller ticky-tack things, but it shouldn't be a deal breaker for you. Okay, that's my opinion on the inspection. But I strongly suggest, no matter what, make sure you get your inspection.
Caeli, before we move on from inspections, there is a poll that was created to see if anybody's ever purchased, if anyone's ever purchased a property without getting an inspection. You want to see if there's a call to honesty?
Let's do it. Yes, let's see what our group says.
There we go. It's on the screen. So have you ever bought a home without an inspection. I can't answer this on the app, but I can tell you I've gone
I
under
have.
with no inspections,
I've done it.
and I've
Yep.
regretted it. I've regretted it less times than I haven't regretted it. Chris Barrett says on chat, he's like, I did, and it was a mistake.
Yeah. You really want to do it. And what do they cost? $200, $300 max, right? More often than
I'm
not.
in Jersey. They're like $600 out here.
Ooh, are they really? Okay.
Yeah, they really are.
Well, okay. It's going to be well worth, if you don't get that inspection and something is wrong, significantly wrong with the property, and even the turnkey or the seller wasn't aware of it. Again, no malice is intent. The intent isn't there. That's a big deal. I've heard horror stories where, they had to immediately crack a check for $20,000 and get a new roof or whatever it was that was missed. Get your inspections, gang.
So there you go.
Okay.
Chris's
Ooh,
story
Chris.
was he ended up spending 60,000 total. Chris, that's a hard lesson. Sorry about
Thanks. Sorry, Chris. I
so
bet he won't make that mistake twice.
that. Out of 19 respondents, 7 or 37% had said yes, they have bought a home without an inspection.
Yeah. Well, you and I admitted to it. I've done it. I did it early on and learned, it wasn't 60,000. Jesus, Chris, I'm sorry. That's a cautionary tale, man. Ooh. Okay. Let's not take a turn down that road. Okay. So inspection, let me get back to my notes. Let's talk about the overall figures of the deal. We've got our rents, we've got taxes, insurance, the purchase price. What are you paying for this property? Vacancy or maintenance, of course, and then there's going to be an other. So let's just take those one at a time. Let's talk about the rents. So obviously we've got all kinds of sources online. You've got House Canary, I think Zillow, and some of the other housing sites will give you what median rents are. There's lots and lots of them. So obviously go ahead and grab at those. But remember, if it is a property that's had any kind of updates, renovation, full rehab, whatever, the algorithms within those sites are not going to account for that. It doesn't have that information. It's not going to know that. So if you see something that comes in low for what is being quoted, just have the conversation with the turnkey or the seller. Why does this report say it's going to be $1,200 and you're telling me it's going to be $1,500? Where is that disconnect? It could be or should be a very reasonable explanation, but you want to ask the question. Okay. Okay. What else did I have for rents? The other thing that you guys want to ask too is that if the property is currently rented, well, find out, ask the question, is it currently tenant occupied? And if it is, I would want to know what was the criteria used to approve that application, right? What did the property, because those are questions that you wouldn't be able to ask after the fact, or well, I guess you could, but if you didn't like the answers, then it might be a problem. I want to know, how was that person qualified? And if it wasn't by the standard in which I think is appropriate, or if it's a very low standard, then you maybe want to add in some extra into the ROI, the cost part for potential vacancy, right? If there's going to be issues there, you want to know about it up front. And then of course, what is the remaining term on the lease? Is there a month left? Is there 6 months? Is there 12 months, etc.? So the rents should be fairly simple for you guys to attain that information and cross-reference from what the performance is telling you. Okay, let's move on to taxes. And Larry, just interrupt me if something comes up. I know you will. Okay, let's talk about taxes. This is a big one, a real big one, because more often than not, well, that may not be true. It's really going to be specific to the county and the state in which the property is located. There may be human error, right? They may have a typo on something. Just make sure that you have confirmed with at least real time what the performance says for taxes and what the actual taxes are. But most importantly, you need to find out if through the sale of this property, are the taxes going to change? There's certain states in which from ownership to ownership, the taxes are going to increase. California is a great example of this. I think most of California, this is true for, I couldn't say 100% if it's the entire state, but I believe most of California with the transfer of ownership, the property taxes based on the new purchase price are 1.25%. And as prices go up, I mean, unless prices have come down significantly, I guess you could actually be in a situation where you're getting an improvement or paying less in taxes. But most often you're going to find that if there is a change in property taxes from ownership, from sale to sale, you want to factor that in. The pro forma will almost always not account for that. Okay, so That's a pretty big one. Make sure that you've got your property taxes dialed in. Just go to the county tax assessor's office. You should have that. The county property tax assessor's website should have all the information that you need, including you'll be able to find. You might have to dig a little bit, but you should be able to find as properties change hands if there is it's called a millage rate. I think it's MILLAGE that will tell you based on per thousand purchase price what the taxes will be in that next year, or however long it takes them to reassess based on that recorded information. Okay, that's taxes. Let's talk about insurance next. These are just kind of the hard costs, right? Insurance is self-explanatory, guys. Get some quotes. I would get several different quotes. I will share with you that from a lending perspective, the insurance coverage needs to include a replacement cost, right? If the thing burns to the ground, what is it going to cost to replace it? So we need to have a minimum of replacement cost for insurance. And as an investment property, we're going to need rent loss. Many of you are probably familiar with that, but that's just the lending side. But do get a few quotes and see where they come up with and how you feel about your deductibles, et cetera. It's always nice to have an agent. If you guys are in multiple markets, having an agent that can do multiple states, because that's just not, they all just can't. So it probably will save you a little bit of time and maybe a little brain damage if you're working with an agent that's in the states that you're going to be considering investments in. And then because the other thing about that is in addition to just having a one-stop, the more you have with one agent, I think you start getting those credits and deductions. The premiums will start to improve a little bit. I mean, ideally you have the same agent that's got your cars and your own home, right? You'll even get more benefit discounts that way. Okay, next up, let's talk about, okay, so purchase price. Yeah, Larga.
Do you want to take any comments?
Yeah.
Or
yeah.
So this is going back to this is from Katia. So comment from Katia was, or find out how long the renter has been there and are they paying? Can you ask for proof of payments? Question mark.
Great one. Good. Katie, I appreciate that. Yeah, duh. Right. And some, it's funny because obvious things that should be so obvious to us as we're doing our due diligence might not be. You might just miss it because you got all these other things rattling around that you want to prepare for. What you really should have, and Larry, maybe we should create this for our listeners. There should be a defined checklist, and I have one. It's not as complete as I would like it to be, so maybe I'll work on that and come up with a due diligence checklist that you guys work from on every single deal. Once you've done it enough times, you probably won't have to refer back to it. But if you're newer to it or you find that, on occasion you're missing a piece or two, once you get so far into the process, it might be nice just to have that to go back and reference. Thank you, Katie. I appreciate that comment. Is there anything else, Lair? You're on mute if you're talking to me.
You can't hear me through mute. That's really disappointing. So Jag was just mentioning there was a very big, I guess, a reference to a pro forma. The pro forma said 5,000, but the county wanted 15,000. This is probably talking about taxes, right?
Yeah. Yeah, I mean,
and we've seen that. I mean, you can see it on even something like Zillow, where Zillow puts these taxes out there, and Lord knows, I've seen it where they've had taxes based upon the ground. And then especially if it's a new construction, right? And if there's a reassessment.
Yep. That happens all the time. You have one expectation, but it's based on the wrong information. Yeah. Bare land is not going to have the same taxation as a real property will, completed property will. So, and if it's a big difference, you could be in real trouble. You guys, I have seen it where in the end, they own this property. They are on the hook for this investment property and the taxes are thousands more than they expected. And now they're having to stroke a check every month just to make the payment, the mortgage payment, and the rents, they're upside down $500 a month. No thanks, right? It does take a little bit of your own due diligence to make sure that you avoid, such horrific, horror stories from real estate investing. You have to be present and a part of this process. Turnkey is fine, but again, it doesn't mean that it's a set it and forget it. It's not, they're not providing you with a perfect little package that says, don't worry about anything. This is going to be this, and nothing else is going to come up. That's not reality. So don't get stuck in that trap. Okay, let's move into purchase price. So you guys don't have to worry about this as much. Certainly, check around. The problem with you doing your own due diligence here is that none of us are appraisers. And the way in which properties appraise is very specific. There are very specific guidelines and formulas that must be used. And people, turnkeys, real estate agents get it wrong most, I feel like. I see it where they say that the property should appraise for this based on these comps. Well, those comps aren't as like kind. There are these 3 other comps that are more like our subject property that I have to use. So, and the value with using these is $50,000 less. So, but anyway, you guys don't really have to worry so much about the purchase price. That's what the appraisal that the lender that we are going to order on your behalf. And because and this may be news to some of you, I hear this a lot. Somehow it's kind of misunderstood that because we're the lender ordering the appraisal, that we have any direct link or even access to the appraiser. Real quickly, as a recap, some of you have heard this before. Go back to 0809 and the fallout of what happened with housing and finance, and think about the term Dodd-Frank. Those are 2 individual last names, came up with this overhaul sweeping legislation as it relates to appraisal, because part of what happened in the 0809 crash was largely about overinflating values. You had appraisers and real estate agents and even loan officers and lenders, in cahoots, grossly overinflating values of properties. Anyway, neither here nor there. We're in a different place now. But because of all of that, Dodd-Frank rules tell us that within an appraisal, everything has to be ordered through a third disinterested party called an AMC, Appraisal Management Company. Okay, the order from the lender goes to the AMC. The AMC is then contracted to put the order out there to the different appraisers within the panels, and then it is a random selection. As the lender, we are not even allowed to speak to an appraiser. Okay, so you can feel pretty confident that well, I have an asterisk here in a second, but you should be able to feel confident that within the appraisal that it is disinterested. They don't deal with the sellers, the agents. It's all from that third party AMC. They're not dealing with the lender, etc. So that should be the fair market value based on like kind properties in the general vicinity. That said, here's my asterisk about the appraisal piece. Like anything, appraisers are not created equal, okay? And by definition, an appraisal is an opinion of value, okay? So one of the things that I have found over the years, and this is specifically post 0809, when we have those new tight regulation with AMC, et cetera, the non-owner occupied side of lending as it applies to appraisal is a small piece of the pie. So the percentage of appraisers that actually do a lot of non-owner occupied appraisals, which are very different than an owner occupied, very, very different. It's small. So as a result, there have been instances, I don't see it so much anymore, but there have been instances over the years where I have found you could get an appraisal, this appraisal from this guy that came in at 100,000, and then the next one comes in at 50,000. How in the hell can the same property within a month's period of time appraise for 50,000 in differential between one or the other? Well, that probably has something to do with the fact that the 50,000 appraiser doesn't recognize that the property was purchased in distress for much under market value, and that the seller put $30,000 into the property, right? That some of that is a disconnect. So as a result of all of that, we have established what's called a self-managed AMC in a way that allows us a little bit more control. This is specific to Ridge. I'm sure there's lots of lenders that impose this. And while all of the compliance rules and regulations are set, having a self-managed AMC allows us to have what's called a preferred panel. A preferred panel is as many appraisers as we can get that we know are going to give us the fairest valuation, that understand the non-owner occupied, right? That understand that there's going to be rehab associated, distress sales. We're not going to let people in on the panel that are coming from 50 miles away that don't understand the nuance of the neighborhoods, et cetera. So while it's still a random selection, the order goes into the AMC and a random selection has to be who grabs the appraisal. We can't pick an appraisal. None of that can happen. But now we've got a panel of appraisers that, again, we believe is going to give us the fairest valuation because they understand the non-owner occupied side or model of all of this. I went down a rabbit hole with that. But in any case, the purchase price is while it's important, do some checking around. That appraisal you should be able to trust is going to tell us whether you're overpaying, underpaying, blah, blah, blah. Okay.
So
Anything, Larry?
Yeah, there's a couple questions. So first question is, and actually Chris had a comment as well, but the question is, do appraisers have to use comps from the previous year? Chris's experience was he had a refi 10 months later, it ended up with the same comps from when he bought the property, and that was obviously surprising.
That is surprising, Chris. And in that case, I would say that there weren't any recent comps. And I am not an appraiser, okay? But the newer the comp, the better. The closer to our subject property, the better. And the like kind, right? You've got bathroom, bedroom, square footage. If it's a daylight ranch, for example, you want to try and find other daylight ranches. You don't want to comp it against a duplex or a colonial or something like that when you can. Now, there's going to be exceptions. Let's say that there are no comps within a mile radius, right? You're out deep in some rural area, you might have to go 2 miles away. So it's not going to be real close in distance. If there aren't any recent sales, you're going to have to go out further than a month or 2 months or 6 months. But ideally, you want to have all of those things that are tight knit inside. So as recent as possible, as close as possible, square footage, bedroom, bathroom, type, all of that stuff. You want it to be as similar as possible. So I need more information, but that sounds very strange to me if 10 months later there were no new sales of like kind that they could have pulled from.
So I got myself on mute again. So the comment from Chris was that you nailed it. That he was the first to rehab a duplex in that neighborhood of 0 duplexes. So there weren't any other sales in that time period.
And that can be a problem, right? If you're the first one in, you may find that you'll have issues in getting the value that is needed or that we hope for. Especially like new construction in planned unit developments, for example, the first 1 and 2, those ones take a beating because if there aren't anything of like kind nearby, the appraiser is going to be forced to utilize comps that, aren't going to be as like kind. Once you've got some sales under your belt, then it's fine, but that can happen. Anything else, Larry?
Yeah, we had a statement really with a question at the end from Katie. So Katie has a challenge with some ARVs for duplexes and triplexes in areas where there are no comps in the last 3 to 6 months. What's the best way to get a good comp? There's some follow-up questions. Do you want them all at once, or do you want to take one at a time?
Let's just do that one let's do that one first. This is actually a good comment and a good topic. I think maybe we'll pause here, and then when we circle back next week, we'll get into vacancy maintenance, other, and then into property management. Maybe we should take some time here, because that should be part of your due diligence, right? If you know that there aren't going to be any like kind, or you're not working with a turnkey, for example, this would be outside kind of the turnkey piece that we're looking at, because the turnkey should know this. But if you know that there aren't going to be any like kind comps, that's a problem. Triplex is the most unique residential property type. So anytime I see a triplex come over, now a triplex isn't going to be as difficult as something else because it's still a multi-unit, right? You could still look at a duplex or a fourplex and adjust above or beyond, based on square footage, et cetera. But if you know there aren't going to be comps, you need to do maybe a little bit more on your end, perhaps order your own independent appraisal in addition to an inspection, and make sure that, or call, you guys are the consumer, right? You're the client. You guys can talk to the appraiser and ask those questions. I'm not allowed to have any conversations. Neither the agent can't have those discussions. Other than getting them access to the property, but you can have that conversation. They may have you, order a whole appraisal, perhaps, or maybe you can just call and, a local appraiser in the area and say, hey, listen, I'm looking at buying this property. What would you recommend I do to ensure that there are comps sufficient enough for this thing to appraise? right? Depending on what your contract says, if you don't have a property contingency, and we didn't really get into that, I probably should have had this on this list. If in your contract, you've got usually a finance contingency, you've got so much time in which to get your financing ducks in a row, and then some kind of a property contingency. But if there's a stipulation within the contract that says, this is what I'm asking for the property, $200,000, if it comes in under value by up to 10%, you, Mr. Buyer, are responsible to cover that spread. Make sure you're reading those contracts for things like that, because there are markets in which the expectation, for whatever the reasons are, whatever the market reasons are, it may come in low. They may expect that it comes in low, and you may be on the hook to cover that difference. And maybe it's okay. Maybe that investment is worth that. Otherwise, you want to know in advance if you're not going to be able to get financing. Because remember, guys, from a lending perspective, the leverage is key for most of us. Okay, we are going to give you money based on the lesser purchase price or the appraised value, the lesser of the two. So if the purchase price is 150,000 and the appraisal comes in at 120, I'm going to calculate your loan to value on the 120. Okay, and then you'll have a couple of options therein that say, okay, you negotiate with the seller to come down, you bring in the difference. Maybe it's some split or combination of the two. Maybe you guys say, okay, 50-50, I'll split it. He'll bring it down this much, the seller bring it down this much, I'll bring in this much, and everybody's ready to go. Or you back out of the deal, assuming that there is a property contingency within the contract that stipulates that. If there isn't one, then you need to be prepared to lose in earnest money. So let me just recap. So Katie, if you've got a property, you want to just check in advance. I would get with a local area appraisal, do your Google search, ask the questions, and if you need to, if it's necessary, order your own independent appraisal. You will not be able to use that appraisal, by the way, for the loan purposes. They have to be ordered through the lender. So that'll just be your peace of mind for, whatever the cost is.
Do you want, because I know you have a list, and we're about 30 minutes into the call. There are some follow-up questions to your comments. Katie is like, oh, okay, thanks. So maybe Katie is good.
Yeah, let's do questions and save we'll have something. I'll finally come prepared next week with content that I don't have to scramble to get that day.
So really, there's, we've had Chris and Katie have both, and I imagine everybody's in this same boat, like, trying to find comps. How does appraising actually work? And obviously, Caeli, you're not an appraiser. I'm not an appraiser. We just have been studying appraisals for 30 whatever years. And the question is really, how can we help the community understand how appraisers' brains work? Do they look for comps of similar size? Do they look for units? Do they look for area? Do they look for quality of construction? Some of those things might be helpful to help explain the magic of what an appraiser does.
Yeah, I think that's actually a great idea for a topic. And in fact, maybe I can find an appraiser. I'll just call someone locally. We don't do a ton of closings in Oregon, actually, for investors, because cash flow is really not something that you find a lot of here. So maybe what I'll do is for one of our Tuesday calls, I'll bring on an appraiser, and he or she can go through the actual 1004. That's the number. That's what we call an appraisal for an investment property. And there are differences between single family and 2 to 4. There's other forms that you guys are probably not super aware of either. There's the 1007, which is the rental income comps, the 216, which is the operating income. All of these different facets are related to investment properties specifically. So we can go into some greater detail, but overall, just to quickly summarize that, like kind, they're looking for like kind and as close as possible. So if, let's just say that the seller or the turnkey selected 3 or 4 comps, okay, and they're like kind, right? We've established that they're like kind, but they are either old, there's newer comps, or they're too far away, there's closer comps. The appraiser is going to disregard those and utilize the ones that are newer and closer. And if those comps are lower in value, you're going to get a lower appraisal. So I don't know if that really covers it. I think that we should have an expert on here really taking you guys through the report, the appraisal report, at least the first few pages, so you can kind of see what the grid looks like. And it goes into all of that stuff that Larry just said, the condition of the property, the age. I mean, there's a lot that goes into an appraisal. I think that, I mean, you guys maybe take a quick poll on that, Larry, and see who would be interested in listening to an appraiser for 30 minutes, go through, maybe longer, go through an appraisal report and show you guys what goes into it.
Yeah, I'll do a quick poll. In the meantime, I did want to address a couple of things that have been floating through the comments here on what is a lender, Caeli? What do we actually use on the appraisal for a means of determining value? Is it sales? Is it income? Is it something else?
Yeah, a good question. So there are several ways in which to quantify value, evaluate a property. There's the cost approach, the income approach, the market. I think there's even one more that I'm spacing, but we're going to use the current market sales comps, sold comps approach for residential for our purposes. Commercial, a lot of times we'll do the income approach. And while on a residential property where we are absolutely using the current market approach, we are still going to gather income data or details. And I can tell you how that works. So for qualifying, when we are talking about debt to income ratio, as it relates to the income of this rental property to help offset the mortgage payment, if the property is not rented, if it is rented and there is a lease there, we're going to use the lease. But if it is not rented, and on a purchase, that's typically the case, we don't usually get the property rented until after we're the owner, in which case the appraisal of an investment property comes with that additional form I mentioned a second ago, a 1007. It's just the number on the bottom of the page, 1007. Rental income comps. The appraiser is going to select 3 or 4 tenant occupied properties, this is public record, of like kind that are in the general vicinity, kind of like the sales comps, and add up the sum of the gross rents for all of them, and then divide by the number of comps that he or she chose. So if he picked 3 properties and they're all $1,000 a piece, divided by 3, okay, the rent that we're going to give you on that part of the report is going to be $1,000. Of that $1,000 of gross rents, you, the borrower, are eligible to get up to, depending on some circumstances, up to 75% of whatever that number is, to help offset the mortgage payment of the loan, and then debt to income ratio then completes itself.
I have that
TMI.
poll. I have that poll ready if you're.
Yeah, let's look.
All right, so let's launch it.
Overwhelming yes, I'm guessing.
Guest appraiser. Would you want an appraiser to explain the appraisal in our meeting? You know, what's interesting, Caeli, is when you look at that appraisal, you know, the output looks nothing like the appraiser's input screen.
Really, I don't even know.
Yeah,
you might be able to tell me something.
I did. Yeah, well, I did a lot of technology work to actually import all the XML fields for the appraisal into Encompass, which for everybody else, that's what Ridge Lending Group uses to process its loans. Looks like we got a yes on this. I'm going to go ahead and end the poll because
100% yes. Okay, done.
So you're on the hook now, Caeli. You got to do this.
Okay, done. Maybe so let's just what's today? Today's the 18th. So next Tuesday, we're going to finish this conversation about due diligence. We're going to get into those final pieces. That's the 25th. And then the 2nd and the 9th, you guys, just as a reminder, I will not be here hosting the live with Caeli. However, what I'm going to do, what I've decided to do, is I'm going to pre-record 2 15-ish minutes. I have to assume that you guys don't want to sit there and listen to me talk for 30 minutes because there's not going to be that back and forth and Q&A stuff. So I'm going to go about 15 minutes each. And what I thought would be helpful is I'm going to go into simulating our certified power buyer calls. Many of you have gone through this with me one-on-one, but for those of you that have not, I'm going to kind of take you through what goes into those calls, the information that is gleaned from those one-on-one calls. And while it'll be generic, you can kind of get a feel for, you know, what you're going to get out of it specific to you and your qualifications and your goals, and how it can hopefully empower you to know more and be more and do more and, yeah, more information. So The 2nd and 9th of May will be pre-recorded. We're going to release those, I think, the night before, the morning of, whatever Larry's going to decide on that. And then why don't we plan then on the 16th of May, I will work between now and then to secure us with an appraiser. If I can find one that will give us their time. I don't know what I'm going to bribe this person with, but give us their time, that knows non-owner occupied, that does a good chunk of business for non-owner occupied. Because like I said before, there is a difference. So we'll do that. Anyway, is there last questions that we want to close out today with, Lair?
So because we actually had somebody just join. So just as a takeaway here, as we come into next week, which is going to be the 25th, we're going to be finishing up this topic, Joey.
Mm-hmm. Due diligence, investment property due diligence.
Due diligence. Okay, great. The final questions or that were on here was from Jag. And so Jag asks, how does the appraisal based upon market rent, what happens if you have a property that's rented under market? Like, what do you do with that? Does that affect your appraised value and your loan?
No. If the rents are under value or under what you should be collecting or what you might be collecting once you own the property, when it comes to our loan and as it relates to the appraisal, the valuation of the appraisal is market comps only. We're not looking at the rents. While that'll be part of the appraisal, that piece of information is not going to dictate what the actual value of the property is, which is what we're going to use to determine what kind of loan we're going to give you, right? 75, 80% of whatever that appraised value is, or purchase price, whichever is less. Remember, the rents included in there might have an impact if your debt to income ratio is overall really tight. If it's currently rented though, if the property has a tenant in it for under market value, let's say that the tenant is paying $1,000 a month, but the appraisal says that the rents are $1,200 a month. Conventionally, I believe we're going to use the lower. We're going to give you only up to 75% of the $1,000. So if your debt to income ratio needed the 1,200, then in that way it could impact qualifying. Otherwise, for the valuation and the actual loan and loan to value and what money we're going to lend you, it won't have any impact, Jag.
There you go. Jag says thank you. Well,
Is that it? Did we get them all?
We got all the open questions.
Okay.
As a follow-up, if anyone has any questions about anything that we've covered here today, again, you can always email to info@ridgelendinggroup.com. You can always call 855-74-RIDGE. You can always reach out on the community. You can always show up here every Tuesday, 4:30 p.m. Eastern, and bother Caeli with every question you can think of, no matter what the topic is. And again, takeaways are, as a reminder, May 2nd, May 9th, not live Caeli, but live on recorded. And then we'll see what we can do about May 16th to get a guest appraiser to explain the wonders of the appraisal report.
That'll be cool. Yeah, I'm looking forward to that myself. And then just as a real quick, Lair, the property manager checklist should be on the community. I believe it's there. If it's not, we can double check.
Yeah, we can make sure it's 100% there. And if you're looking for, if you're looking for it, of course, I'm not going to find it really quick, right? Because I'm searching for it.
Okay, well, you're looking for it. I will tell. So Larry's going to look for it. He's going to tell you where to go to find it. If not, we're going to put it up there. If you guys feel ambitious, go ahead and grab that so that you have it when we talk next week, because I'm going to go through some of that stuff when we get into the property management of due diligence for real estate investors.
You probably have to spell management correctly, don't you? Is that the rule?
I think that's a requirement if you're going to be searching in the search bar. Yeah.
So if you search, go to the community, into Ridge Lending Group community, and at the very top you type in property management checklist. You'll see it's the second or third tile on there, and you'll see the property management checklist as a PDF that you can download and enjoy.
Thank you, Larry Bailey. Yeah, if you guys want to grab that now, if you feel like it, have it ready for next week. I'll probably share screen, so it's not mandatory, but grab it and save it to a desktop so that you can refer back to it whenever you want. Thank you guys for being here. I love this time with you. I really appreciate everybody's support. Reminder, get us your topics. If there's something that you guys want to hear about or know about, whether it's specific to you or a story or anything you've heard, let us know. I need your juices helping me come up with things to talk to you about, because otherwise it's just gonna be the same, you know what, every single week. And then, yeah, who's got time for that?
That's boring. We don't want that.
No.
No.
Okay, gang. Thanks for being here, guys. See you soon. Bye, Larry Bailey.
Bye, Caeli Ridge.